I very much hope you are watching this in time, because what we have before us is going to be the most pivotal trading week of the entire year. And I'm not just saying that as some sort of bombastic, crazy statement. I truly mean it, because what's going down is going to be a huge change in monetary policy. And one of the crazy things about this huge change is no one knows how big it's going to be. As I'm about to show you, the markets cannot make up their mind about what's going to happen in about 2 days. Now, just very quickly, the TLDR, for those of you who maybe aren't paying attention because you're probably living a normal life, and hey, congrats on that. But the Fed is about to have an FOMC meeting, a Federal Open Market Committee meeting. It starts on Tuesday. It concludes on Wednesday. We get the results at 2 p.m. Eastern, and then at 2:30, 30 minutes later, the chairman of the Fed, Mr. Jerome Powell, Daddy Powell, the guy who makes the money printer goes burr, he will be speaking. What's crazy about this situation is for quite a while, we jacked up the Fed fund rate, then we were holding it constant at 5.25%, and now we know we're gonna get a cut. There's a lot of concerns that maybe the underlying foundation of the economy is starting to show some cracks. Maybe they need to take their foot off the neck of the economy. We need some breathing room. That's what's going down right now, because they jacked it up to fight inflation. Inflation has trended down. And yes, prices are still high, but remember, inflation is the rate of increase of prices. I'm not saying prices themselves are coming down. I'm saying the rate of increase of prices themselves are coming down. So now that they took care of that, now that they're starting to see some weak economic signals, it's time to get a rate cut. The question now, what is the cut gonna be? And it's insane that right now we do not have clarity. It's a big week for central banks around the world with a slew of rate moves on the table. So it's not just the US. Globally, we have things going on. And on top of that, there are other things such as retail sales report. As you're about to find out, the options market's gonna go nutty because this Wednesday, we have expiration for volatility. And then on Friday, we have quadruple witching. So a ton of money's going to be moved. This is all, I don't know, this is the crescendo, if you will, of just absolute market insanity. So as of now, there is a 41% chance of a 25 bips rate cut, because remember, we're currently at 5.25%. As of now, there's a 41% chance of a 25 bips rate cut and a 59% chance of a 50 bips rate cut. For those of you who've been paying attention to how these numbers have been moving, just last week, on Wednesday and Thursday of last week, it was 85% chance that we're going to get a 25 bips rate cut. So the odds of this are dropping while the odds of a greater rate cut are starting to spike. And we're just seeing craziness in the market right here. This is over the weekend. The Asian markets opened up first. We can just see the odds of the 50 bips rate cut spiking and spiking. Maybe because big banks, including the world's biggest bank, JP Morgan, reiterates its call for a 50 basis point rate cut this week. Even the banks can't make up their mind. Some are saying 50, some are saying 25. Right now, as retail traders, unfortunately, we're just stuck in between. The Fed has the proof it wants that inflation is slowing down, but the next move is still up in the air. The fact that these odds are not solidifying on a level we know is just truly crazy. We know we're getting a rate cut. We all get it. It's just how much. And then obviously beyond that, you're probably thinking to yourself, well, what are the odds? Like, okay, whether 25 or 50 is it bullish, is it bearish? That's probably why you're watching this. And that's a phenomenal question. A couple of things I want to talk about. When you're bullish or bearish in terms of your bias, remember time frame is absurdly important. Now, in the short term, if you look at the last how many ever FOMC meetings, in the very short term, the day before, the day of, and the day after does favor the bulls. Am I saying it favors them 100% of the time? But no, if you took a bullish position the day before, the day of, and the day after, hypothetically, on every single FOMC meeting over the past 10 to 15, you would be in the green. In the very, very short term, it is bullish. In my humble opinion, and this is just my opinion, so please take it with a grain of salt, if we end up getting that larger rate cut, the 50 bips rate cut, I think that's actually going to provide quite a bit of liquidity to the market. And I still very much think we're going to stay in a strong risk on environment, aka bullish. Now, that's the very short term. What about the next couple weeks, the next couple months? I do want to kindly remind everyone that from the 1950s to the 60s, all the way up until now, from the moment of the first rate cut until we actually bottom, there's been a double-digit drop in the market. So when I hear this rate cut of like, okay, yeah, in the short term, I think it would be bullish. That's just my opinion. But Am I all of a sudden going to be adding things to my medium to long-term account? No, I'm going to be patient and wait 3 to 4 to 5 quarters to see if I can buy some of my favorites for that long-term investment. Because of course, if I love the equity, I just want to be invested at a better value. One thing I want to point out to you here, shout out to Brett ETH on Twitter. 4 days until the FOMC meeting where Powell will likely cut by 25 bips. I think it's going to be 50 bips. Pointing out the similarities between 07, we all know what happened in 08, and what's going on right now. So you can see the first rate cut, September 18th. Okay, that's an interesting one. Unemployment, 4.7 versus 4.2, very similar. Inflation, 2.5 versus 2.5. Housing starts, 1.24 versus 1.24. Leading economic activity, 100.4 versus 100.4, and existing home sales, 4.5 million versus 4 million. Lots of similarities in terms of the backdrop of the economy, but look at what happened in 07. Yes, we got that initial spike. Once again, this right here is not changing my opinion of the short-term reaction, more of the medium term, the next couple weeks, the next couple months, and they had a very rough year from 08 to 09. I mean, obviously, unless you're living under a rock, you know what happened there, but the market got absolutely demolished. Yes, it's the great financial crisis. We know that the housing sector collapsed, but it was also marked by spiking unemployment. Employment's going up right now. It was also marked by a bullish steepening of the yield curve. Remember when it was inverted, it was in the negative territory, and then when it came back up to zero, it started to rocket. Well, we know that line is highly correlated with the unemployment. Now, do I think that we're going to have a housing crisis this time around? No, but there are other potential black swan events of what's going on with the yen carry trade, what's going on with China. There's various little things that are like, okay, where is the stress in the system? Now, is this by any means a guarantee? No, I'm just presenting it to you so you know some of the ways that we've been set up in the past and how it's played out. Now, the future, I have no crystal ball, but I just want you to know this. I also want you to know that with respect to seasonality, there is a mid portion of September that favors the bulls, pretty much where we are right now. But I do want to let you know that the second half of September strongly favors the bears. In fact, this drop off, historically, this is from the past 2 to 3 decades worth of S&P 500 data of just how has it performed in the aggregate. Well, in the aggregate, the second half of September is one of the worst performing weeks of the entire calendar year. Once again, does that mean that this time around it has to be bearish? Absolutely not. But I just want to let you know how things have played out historically. So yes, we're going to have a big interest rate decision. On top of that, we have other macroeconomic reports. That's all in the US. Globally, we have a lot going on in Europe. We have a lot going on in Japan. We have a lot going on in China. On top of that, we have crazy things going on in the derivatives market. We have quadruple witching on Friday. We have volatility expiration this Wednesday. So that basically means buckle up. In my own personal bias, I think the short term is bullish. I think the medium term is bearish. I think next calendar year could be rough. I think we end up bottoming out, and then I think we have a ripper of a bull market. Those are my own opinions. I'm not telling anyone to trade on it. It's just how I currently see everything going. But what I can definitively tell you is you better buckle up your socks because they are going to be knocked off this week. And of course, Godspeed. Please protect your downside risk. Please, please, please.